Here's a question which some of you may not agree with. Tracking the recession, is it possible we avoid the recession? Could it pass us by? Could we be in store for just a soft landing? We've had some good numbers this week. Durable good orders increased the highest since May of 2020. Durable goods are those computers, appliances, items that are meant to last more than 3 years. The numbers are strong. The net number goes back to highs we haven't seen since November of last year. On a year over year basis, up 1.3%. And that's the best number we've seen since about February of this year. And by the way, it's the first positive number in the past 4 months. Certainly an improvement, and it bodes well for the housing markets. Speaking of the housing market, S&P Case-Shiller Home Price Index hits all-time highs for June of 24. This is the S&P Case-Shiller Home Price Index. It's been strong. It's been really strong. S&P Case-Shiller Home Price Index on a 5.4% year-over-year basis. It shows us we're gradually declining, but this is a comparison year over year from June of 24 to June of 23. So certainly we'd like to see this make higher highs on a year-over-year basis, but nevertheless, it doesn't look like it's going down at any rapid rates. The U.S. economy grew at a 3% rate in the second quarter. This was an upward revision from last month's 2.9% estimate. This is GDP we're talking about, 3%. Better than the first quarter. That was at 1.4%. Not as good as the October 3.4%, nor July of 23 at 4.9. But nevertheless, remember, a recession is 2 consecutive quarters of negative GDP. It doesn't look like we're talking about negative GDP anytime in the near term future. By the way, we've launched a new revised poll in terms of when we think the recession may come. We've been tracking the data. We certainly thank everyone for voting, and we'd ask you to vote again. Let us know when you think the recession is. We're comparing this data to what the market's telling us. In terms of the Fed funds futures, we have a September meeting. There's a 70% chance we're going to get a quarter point cut. That's red. The red bars here, 5 to 5.25. There's a 31% chance that we get a half a point cut going down to the 475.50 range. And notice the red bars in particular, they're going up. The yellow bars are going down. And what this is telling us is the market is really firming their decision that we're only going to get a quarter point cut. We had a scare with the Bank of Japan, just not too long ago, a couple weeks ago, but all those fears seem to have subsided. At that point, we were talking about a strong possibility of a 50-point cut, but really the fear has cooled, and now most likely we're going to get a 25 basis point cut. Now, in blue, left-hand side, that represents the probability of a 25 basis point cut, quarter point cut in September. That's at 70%, 31% that will get a half a point. In November, we have the best chance, a 50% chance that interest rates will be half a point lower than where they are now. So a quarter in September, a quarter in November, December, that's 425 to 550, and that represents a full point cut. And there's a 45% probability by December we're going to get a full point cut, which is actually kind of interesting because right now we're at the 5.25, 5.5. In September, we're predicting, not we, the Fed funds futures are predicting a quarter point September, a quarter point more November, but by December, now the market is predicting there will be a full point down. Market's predicting that we're going to get a 50 basis point cut in December. Funny, I don't know if it's a conspiracy theory or not, but we're expecting a bigger rate cut after the election and not before. Interesting to note. Now, the Fed's preferred inflation gauge shows prices increased in line with Wall Street expectations, and they're talking about inflation, the PCE data that was released earlier today. PCE, personal consumption expenditure on a year-over-year basis, 2.5%. This was right in line with expectations, in line with last month's number. We're right where we want to be as far as the Fed's concerned. With the core PCE, excluding food and energy, That was released at 2.6%. The Fed has a roughly a 2% target for core PCE. That really is the number one gauge they're looking at. Of course, assuming the housing doesn't fall apart. It's been going down very slowly. I don't think that this month's pause is necessarily a bad sign. It looks like inflation is still more or less, the moving average. It's moving in the right direction, although, again, quite slowly. So, if all these numbers are good, why does it still feel like we're in a recession? There's a recent poll that respondents said that 59% of those people polled said that we're in a recession right now. Why is that? Well, we went through several economic numbers to try to find the answer to that. And we put it together in a Substack article. It's absolutely free to read. We'll give you the link in the description of this video. And I think that you're going to find what we found here to be quite interesting, that the consumer confidence and the GDP and the CPI does not necessarily tell us how we feel. It just tells us how growth is or how inflation is. But our feelings shouldn't be ignored, what our experiences are. And that's a lot closer linked to the inflation gauges that we talk about in this article. I think you'll find it quite interesting what we discovered here. And again, these are our stats from our little experiment over here. Every week or so, we take a poll and we ask, where do you think we're going to find a recession? So far, the blue bars represent August 8th. The red bars represent August 17th. On August 8th, 35% of you said that we're going to have a recession. It's going to start by the U.S. elections in November. That has moved up to 37%. There's now just a little bit more respondents are now predicting we're going to get a recession sooner rather than later. What's interesting is that the poll, look at all the way to the right-hand side, the soft landing. On August 8th, those that responded to our poll said 23% of them said we're going to get a soft landing, meaning no recession. And now 12% are saying we're going to get a soft landing, meaning we're getting more bearish as far as our sentiment is concerned. Interesting to see the economic numbers that we speak about, Case-Shiller Home Price Index and the durable goods. Those seem to be improving. GDP is good, PCE is good. So why are we getting more negative? Well, it's a very interesting divergence, and I don't think it's going to last. But we'd ask you, please vote on our poll. The more of you that vote, the more accurate our data will be. And we thank you so much for participating and for joining us. We hope this has been helpful. We look forward to seeing you back soon.